Record the cloud. And we're recording, Thomas.
All right. Welcome back, my friends, to episode 100, a nice milestone of the Mail Right Real Estate Agent Podcast Show. And, of course, my co-host, Jonathan Denwood, the founder of this show, has been on all 100 episodes, or actually a few he skipped it, and I left me to do them solo, but we'll give you credit for all 100.
Oh, thank you, Thomas.
And, of course, I made my debut on episode 57 as a guest, and then you just couldn't resist my charm. So by episode 66, I was a co-host.
I could see potential there. It was rough. It was a rough stone, but I could see potential there.
Well, I'll tell you, I'm excited about the guests we have today.
It needed a good painting and a bit of renovation, but it will be a good, I knew it could be.
Well, I want to introduce our guest, John. I'm just going to destroy your name, Agostinelli. How come I said it right before, and now I'm destroying it? Jonathan, you're all flabbergasted now. John Agostinelli of the Agostinelli Realty Group in Massachusetts is joining us today on episode 100. You want to introduce yourself a little, John? Tell people who you are and what you do.
Yeah, sure. First, Jonathan and Thomas, thank you so much for having me on. I'm a real estate broker and investor. My real estate career started in the late 80s in the banking industry. I worked at the FDIC for 6 years after college. We examined the causes of bank failure, and then I moved over into the foreclosure unit where I managed foreclosures in several New England states. And then in 1997, I started a spec home building business. And then at the end of that year, I started a real estate brokerage business, primarily to list and sell the spec homes I was constructing. Small builder, basically building 2 homes a year. Did that from 1997 through 2005, and that's when the market turned in the Massachusetts area. My market area is halfway between Worcester and Boston. It's called the Metro West area of Massachusetts. So the profitability started to fall out of that right in 2005 when the markets turned here, about 18 months prior to the national market turning, the national average turning. And then I decided to get in to try to solicit banks for their bank-owned inventory because foreclosures were starting to mount.
Yep.
And that's I purchased a real estate franchise. That's where I met my co-author. Collectively, we have over 50 years of experience in the business, and we decided to pool our experience to solicit the banks for that inventory. Now, this was in 2007, really before the crap really hit the fan, and we went from no listings to over 100 in about a 16-month period.
Wow.
So once the financial crisis took hold, that was in 2008, we really ramped the business up and sold hundreds of bank-owned properties since that time until we got out of the business in about 2013.
So, and I know you touched on your co-author, which implies you wrote a book, and of course we know you did, and we're going to discuss that book. But before I get to the book, I want to ask you because, I came into real estate as a small business owner. I had small business experience, and a lot of agents I come across don't. They just get a license and treat it like a job. You have to have a unique perspective on real estate coming out of FDIC and knowing what you know and seeing what you've seen. I mean, what is your take on real estate and how you see realtors approach the business, for better or for worse?
Interesting question. Well, coming out of the FDIC, I was managing foreclosures, and primarily it was from the bigger developers that had gone upside down once the market had turned. Now, this is going back to the last cycle that back in the late 80s, early 90s. It peaked out, I think, in 1989. So from that, I learned to be extremely conservative. So when I got into constructing homes in 97, I was only building a couple at a time. The real estate market can't turn quick enough to get hurt if you only have a couple houses going. If you have a 25 lot subdivision and you have a 3 to 5 year sellout period, you can get hammered. You can get rich, but you can also file for bankruptcy. So coming into it, I think I was much more conservative than my competitors. So to your point about the mindset of the average realtor out there, I agree. I think that, I hate to say it, 20% of them do 80% of the business. That's
Right.
a pretty well-known statistic, and it's that way for a reason. That 20% is usually educated, continues to research the market, really knows what's going on, and those are the people that buyers and sellers should be really looking to work with.
Does the Agostinelli Realty Group mainly deal with these spec homes you build, or do you handle retail sales and listings as well?
Well, so my business is changed with the markets over the years. So we changed and basically sold almost exclusively bank-owned properties from 2007 through 2013.
Yep.
Of course, if a family member or a friend or a past client was looking to do a real estate transaction, I helped out there too, but that was a smaller percentage of the business. I would say 90% of it was really from the bank-owned properties, whether it was on the list side or the buy side. I've represented quite a few real estate fix and flipper types.
Right. So do you well, I don't know how else to phrase it. Do you deliberately avoid retail sales, or is it just because you're so busy with your spec housing and back then the REOs?
Well, it's interesting. Now, again, my business is in flux. We just finished the book. We're just really on that middle part of marketing the book. But now I'm focusing on getting back into business, and that's a combination of, right now I'm not building any spec homes. It's more fix and flips, and I am doing some traditional listings, which is a change for me because it's been quite a while since I've been doing traditional listings.
Gotcha. Well, we've alluded to this book, so why don't we dive into the book? Because I was excited to have you on just because of your background, but also because you're an author, and that's something that we share in common. Jonathan found me through my blog. I'm an avid blogger, and I enjoy when colleagues write books. I know several realtors that have written books, everything from romance novels to murder mysteries to actual industry books. So it's kind of cool. I think we're a creative bunch. So the book, tell me the title.
Okay, the title of the book is Easy Money and the American Real Estate Ponzi Scheme.
A very enticing title. So, well, let me ask you this. Would you have written this book had you not had your prior banking and FDIC experience? Or do you think it stemmed from that experience you had in your repertoire to have the audacity to write this book?
That's a really good question. I think that experience gave me a broader experience base to form opinions when we were selling these bank-owned properties. So both Chris and I, my co-author, have been through a couple real estate cycles. Chris has been through 3. I've been through 2. And I think it's the combination of that experience. So we witnessed some of the nonsensical lending practices that were happening leading up to the bubble.
Right.
Then once the bubble burst and we were selling these bank-owned properties, we had the opportunity to meet hundreds of people that were foreclosed on that were still in their house and then eventually needed to be evicted. So we got to hear their stories, and we witnessed the disconnect between what the media was reporting as the true causes of the collapse and then what we witnessed. And fortunately, both Chris and I should say, were fortunate enough to serve on a broker advisory council to the largest mortgage servicer in the country. And it really gave us an opportunity to speak to other top brokers across the country to verify that what we experienced in the Northeast was really happening throughout the country.
Yeah, I would agree with that. I mean, I did a lot of REOs, but I did a ton of short sales. And with the REOs, you may or may not ever meet the homeowner. But with the short sales, you're not only meeting them, you're spending up to 10 months with them.
Yeah.
Or in the case of my very first short sale where I had no clue what I was doing, 2.5 years.
Right, right.
So, you know, and it was so frustrating to like you were saying, hear the stories of these actual people going through this, watching their lives just getting torn apart. Meanwhile, the media is talking about something completely different. And I'm thinking, where are they reporting this news from? So the book is, well, can you, I know it's a broad subject, but can you kind of surmise what's the book about? What did you address in the book?
All right. So the primary reason we wrote it was this disconnect between what was being reported and what we witnessed. So we talk about what we believe were the primary causes of the real estate crash and subsequent financial crisis.
Yep.
So we really go into more than just it was greedy banks and Wall Street shenanigans, because it was much more complicated than that. Really, we believe the root of the problem was and is poor government housing policy that's based on a false premise that homeownership is a great financial investment. So we talk about that. We talk about the Community Reinvestment Act. We talk about the Federal Reserve and how they manipulate rates and the effect it has on the real estate market. We briefly discuss rating agencies, mark-to-market accounting, but we also talk about the real estate industrial complex. So are you familiar with that particular term? So really what we're referring to there. Go ahead, Thomas.
Well, I was going to say, to be honest with you, only because I did my research on your book.
Okay. So we know it's I don't know. I don't think we coined that term, but really the real estate industrial complex refers to the National Association of Realtors,
yeah,
the National Association of Home Builders, the Mortgage Bankers Association, the America's Bankers Association, and then there's a couple other acronym groups where you have dues-paying members that want their cause supported at any cost. So I'm a dues-paying member. I'm a realtor.
Mm-hmm.
So what does the Realtors Organization do? They do anything they can to promote housing and to promote housing at any cost.
Yep.
I make more money if I'm selling a $500,000 house than if it's a $400,000 house. Same thing with anyone that's the mortgage originators, the lenders. They make more money off of a $300,000 mortgage instead of a $250,000 mortgage.
Yep.
So we really hit that group hard too, because when you read a newspaper or an article about housing, who are they quoting? Right?
Right.
They're not really digging deep in finding the truth.
No.
They're going to these associations that have an ulterior motive, if you will.
Yeah. No, it's true. I mean, and I mean, and to your point, and at the risk of being on a very short soapbox, the other thing we've talked about on this show in the past is not only does NAR at all costs promote buying and selling homes, which as a realtor, of course, I support that, but they also at all costs support their cause of new members. Just members,
right?
And we all know the training involved in getting a real estate license.
Mm-hmm.
So I mean, I think my manicurist goes through more to get her beauty school certificates than a realtor goes through. So it's interesting you bring up NAR because recently NAR's come under fire just for their lack of response to the whole Zillow moves that they're making in Nevada and Florida right now,
mm-hmm.
Which I won't open up that can of worms. But
mm-hmm.
Getting back to your book, well, let me ask you this before I dive in. I would imagine you got a little pushback. What kind of resistance did you get from not only maybe the community at large, but from your peers, from the real estate community?
It's interesting that you ask that question because I never really thought about it, and I wonder if people have thoughts and are just not expressing them to me, or if they just recognize that what we're saying is actually accurate. So. To be honest with you, there hasn't been much pushback, but I'm not sending the book to the National Association of Realtors. We're not promoting it to those groups. So my guess is that if they really dug into the book, they would try to discredit it somehow.
Well, and maybe because we've had I mean, I've seen some movies that, I mean, I'm on the edge of my seat like it's a Stallone movie, only I'm watching The Big Short or Too Big to Fail or Inside Job and Margin Call. You know, those are the movies that just get me fired up. And so with enough of that paving the way for you, the book really, in a sense, is not as controversial as it may sound, just from knowing what we know now. But the point I'm getting to is, so you've written this book. Why do people need to read it at this point? What's the compelling reason to read this book?
Well, they need to read it if we want to affect change and avoid the next crash. It's coming. So a lot of the same policies that we saw in place leading up to the last bubble are in place today. So we've all heard that mortgage lending is tight.
Right.
Tight relative to what? Right? Tight relative to the nonsensical lending practices that were available in 2005 and 2006, where you could liar loans, you could state your income, no documentation loans, interest-only loans, option arm mortgages. So those products, which were at the time called sensible mortgages, were just the opposite, right? So the Dodd-Frank Act, some good came out of the Dodd-Frank Act. Those loan products are no longer legal. But outside of that, we are seeing Fannie Mae, Freddie Mac, FHA, VA doing the same things that they were doing leading up to the bubble. So just the other day, I read in an article that, so the Dodd-Frank Act said that the maximum debt-to-income ratio can be 43%, right? But Fannie, Freddie, all the government agencies are exempt from that. So Fannie and Freddie were doing debt-to-incomes up to 45%. They just announced yesterday, or I just read it yesterday, they're now going to 50% debt-to-income. That doesn't leave much margin for a financial upset, a loss of a job, or reduced work hours. All of a sudden, there's no money left to go to the mortgage, or should I say, food and other living expenses.
Right. So we're starting to see a familiar sight. And of course, you bring up Dodd-Frank, and what was it, June 8th or so? I think we saw the repeal of the Dodd-Frank. So what's your take on that? What's that going to open up for us?
Well, so it passed the House. And I think that when people read that headline, they're like, okay, Dodd-Frank is gone. Well, not so fast. It has to get through the Senate.
Right.
My gut tells me it's not going to happen. So where does it go from here? Do we go back to status quo? Is Trump able to enact some executive orders that kind of reach some sort of middle ground? It'll be interesting to see how it plays out. But he's made clear, he's made clear that he wants to get rid of 75% of regulation, and he's done what he can to reduce it from executive orders.
Well, and I can remember last year, I literally had buyers especially hit the brakes and go, I'm waiting until after the election. They based everything they were doing personally on the outcome of the election. And that's another soapbox I'll avoid. But what is, and this is probably a different answer today than it would have been if I asked you in January, but what do you think that this administration, that Trump's administration is going to, how's it going to impact our real estate market in just in the coming year?
Okay, so right out of the gate, he had an executive order. I think it was within a week of when he was sworn in, to suspend the FHA mortgage insurance premium cut that the Obama administration slipped in at the 12th hour. So we believe that was a wise decision, since the Mutual Mortgage Insurance Fund that is there to cover any potential losses at FHA. So Congress mandated a 2% threshold.
Right.
So that 2% threshold wasn't enough to offset the losses that they took during the financial crisis, and it cost the taxpayer $1.7 billion. Now, this cut would have saved anyone borrowing money from the FHA, if the cut actually went through, about $40 to $50 a month. But I will argue that if that's how close you are financially as to whether you should purchase a home or not, I would say maybe you're not quite ready to purchase a home. So I believe it was a wise decision. I believe that mortgage insurance fund needs to have a cushion because real estate markets go in cycles. We know it does. And I think that we need to save for that rainy day and not ask the taxpayer to bail them out yet again.
Well, I agree to that to a certain point because I mean honestly, based on the conversations I've had in the last year, that rainy day is well, I was expecting it to hit already. It's been cloudy for a while, but we just haven't seen the rain. So, I mean, we were anticipating some significant changes this year that haven't happened the way we thought they would. Now, I mean, in the short term, that's great for the market because, it's a busy market. Jonathan and I, right before the show, were talking. I mean, I've already made my numbers this year in June that took me all last year to make. It's just been a lot busier number of transactions going on. And I think some of that came from when the Fed initially were going to raise rates earlier this year, which, that was a big fizzle. So bringing up the Fed, how's the Fed playing into this year? I mean, what's your take on what the Fed's doing?
Okay. I'd like to go. Do you mind if I go back to Trump for one more second?
No, please do.
So then we'll get into the Fed. So I think it's important that we talk about how some of the things that he wants to accomplish. He would like to get rid of Dodd-Frank. He would like to get rid of the CFPB. He has proposed a $6 billion cut to HUD. So these things could have an enormous impact on the real estate market if they were all to come to fruition. Now, I think that many of his ideas will not come to fruition, but if they do, it would have a huge impact on the market. So to say with any certainty, like what's going to happen, I think is a fool's errand because we don't know until those policies either get approved or the legislation does not pass. So it'll be interesting to see what happens moving forward. So I think there's a huge variable on which way the market can go based on the outcome of those things. Getting to the Fed, another huge variable, right? So originally the economy looked extremely strong. The thought was that there were going to be 3 or 4 rate hikes this year.
Right.
I do believe that we're expecting to have one in June. Now, from what I've read, that the majority of people think that it's likely that there might not be another increase this year. So originally they thought there would be 3 or 4 increases.
Right.
So it's interesting to note that the 30-year fixed rate is still below 4%. I mean, we're within 1% of a historic low.
Right. It's amazing.
It is amazing. So, of course, if the interest rates continue to increase, that's going to have downward pressure on real estate pricing. But I don't see it happening, and I don't see it happening fast if it does happen.
Well, and bringing that up, so some of the scuttlebutt in my market is people are starting to have that familiar feeling of 2006 and 7, because here in San Diego, we were knee deep in it by 2007. I was already doing my first short sales in 2007. Late 2006 was when I got my very first one. And so anything that reminds people of that time, they start really backing off. And everyone keeps asking me, well, when are these prices going to level off? When, now I don't see them going up in the leaps and bounds they were going up in 03 and 04. Appraisers are being a lot more stringent on that. So you have to have the cash if you want to go over and above. Whereas before it seemed like they were just signing off on at value all the time. So we're not seeing that as much. But what do you tell people when they're in this kind of limbo of the market seems like it's strong, but it's starting to look familiar to the 07, 08 era?
So that's a great point. So we dedicated 2 chapters in the book to this subject. So really, the first chapter talks about what a typical real estate cycle looks like, right? So we talked about it earlier. You reach the peak, then it goes down into a recession phase, you hit the trough, and then it starts coming back up. So I think it's important for buyers to understand that there is a cycle to it. So, of course, as you're approaching the next peak, it increases risk. So we have a chapter dedicated to what a typical cycle looks like. And then the next chapter talks about why this most recent cycle had a larger amplitude. Mm-hmm. Now, there are some economic theorists from 125 years ago that talked about the real estate cycle and that the average length from peak to peak or a trough to trough being about 18 years. Coincidentally, this most recent cycle was 18 years. The one prior to that was 10. So there's some guide there. But what we do in the book is we give the tips and tricks of how you can determine where your market is in that cycle. Because what happened in Metro West Boston in 2005, we were well ahead of the curve when we reached the peak. So we were 18 months different from the national average. Mm-hmm. So it's important to understand that when you read an article about the where the real estate market is, they're usually talking about a national average basis, and that might be good for you, or it might be completely unrelated to what's going on in your market.
That's so true. I mean, I can remember talking about short sales with, I'm originally from the San Francisco Bay Area, and I still have realtor friends up there. And I was telling them, we're getting hammered down here, and they didn't know what I was talking about. It was still, boomtown up there. Their market didn't really hit the skids until late 2007, early 2008. Mm-hmm. So they were experiencing it almost a year later than we were in San Diego, California.
And that's why it's so important it's not just location, it's also price point, right? So what's happening on the lower end of the market? So lower end of the market for us out here is, 300,000 or 400,000 compared to like what's going on over $1 million. So there's a big difference between, even in the same region, at different price points. So I think, and we stress that in the book, but I think it's important for people to understand it so they're not using something they read that might not apply to their market.
Right. And again, we're talking about the book Easy Money and the American Real Estate Ponzi Scheme, folks. And I'm going to jump over to Jonathan because I'm getting that look like it's time for a commercial.
I think we've got another 5 minutes, but because I knew this was going to be a detailed interview. It's a fantastic book, folks. I've just got a quick question, and then maybe we'll go for a break. Okay. What are some of the fundamental drivers of the present market, John? What are some of the fundamental things that are supporting the prices that we're seeing in certain areas? In Reno, there's a couple of houses that recently gone up to sell, and some of the shakers and movers in the Reno community have just stated that they're just crazy prices. They're extremely worrying where this is going. They've put their voices on Facebook and in the local newspapers. So what are the drivers, John?
Right now, and I think we're seeing this throughout the country now. I guess I come from a more what's going on in Massachusetts mindset, but I think it's happening throughout the country. There's a limited supply. Yep. Household formation exceeds new construction. So whenever that is the situation, until there's some type of balancing point between supply and demand, we're going to continue to see increasing home prices. Now, are we going to continue to see 5 to 6% increases per year moving forward? I don't think so. It's possible. It depends on your market. I think we're more likely to track inflation, maybe 3%, 4%, at least in the near term. So until we get some type of balance and new construction keeps up with the demand, we're going to continue to see home prices increase, especially at the lower price points, because newer construction, the average new construction is 2,600 square feet, right? So that's at a higher price point. So I think we're going to see higher price appreciation in the lower price bracket. That's in my market, again, say between 200 and 500 is going to see higher appreciation rates than we're seeing over $1 million.
I would agree with that. It's what we've been talking about for years out here is it's just a simple supply and demand factor. The other thing playing into it, of course, is that it's in San Diego and San Francisco and other major metropolitan areas, it's more expensive to rent than it is to own in many cases. Now, the down payment factor may prevent people from participating in that in certain loan cases. But overall, if you do the math, factor in the tax deductions, you are actually paying less per month to own a home in San Diego than you are to rent a home. And that's why people are saying this doesn't make sense. But the rental market's blowing up here too, because so many people aren't buying homes or are unable to, and that's what they're left to do is rent. So we're seeing both rental markets and the resale and new construction markets just blowing up. And John, to your point, San Diego sounds like it's a similar price point market to you, and we're seeing the same thing. Essentially, if you're buying a single family home new construction, it's practically the luxury market at this point, or it's multi-unit dwelling, mixed use. The latest trend out here is retail, ground floor, and multi-unit living, second floor and up.
Oh, fascinating. I think we will go for a break now, folks. And when we come back, we'll be talking to John some more about how this market is going to move and some of the things we should have learnt from the last calamity. Be back in a minute, folks. We're coming back, folks. We're going to be discussing more about the market. As real estate professionals or people involved in the industry, you should have eye on the market and should educate yourself so you're not one of those that just gets swept up with the media. You know what's really going on. Back to you, Thomas.
Thanks, Jonathan. So, obviously, John, you and I are in real estate, and our job essentially is to buy and sell real estate or represent people that are. But that being said, I'm not in the business of just cramming people into something for the sake of getting a sale, because ultimately my business is built on a foundation of referrals and relationships. So I'm going to ask a question that we might not all like the answer to, but let's start with, do you think right now is a good time for people to buy a home?
All right, so I think to answer that question, we can even answer another question first, and that's whether or not home ownership is a good financial investment. Right.
All right,
so
let's talk about it.
All right, and then we can go into is now a good time. So to answer that question, I think if you look at Case-Shiller's did a study over the last 125 years that homes have appreciated 0.3% above the rate of inflation on average over the last 125 years. So that sounds pretty good. But I don't know if you've ever taken a close look at how the government records inflation. I believe they underestimate or understate what the real rate of inflation is. So then if you do your spin on that, maybe right there, it's a negative rate of return. But let's assume for this argument that it's accurate.
Okay.
From that.
But before, I'm sorry to interrupt, but just to be clear, and I'm just going to give you my novice understanding of inflation, that I've always been told it's about 3% a year.
Yes. So historically, for the last 125 years, it's been, I think, about 3.5%.
Okay.
Now, more recently, like in the last 10 years, it's been closer to 2, maybe 2.25.
Okay. Just so we're clear on a number that we're assuming.
Sure, and
that's accurate with.
So, in the Federal Reserve targets inflation, right? They have their monetary policy, and one of the factors of how they move the markets and what they do with their rates is to try to accomplish a 2% inflation rate. All right. So how good they are at that is a different question. But from that 0.3%, let's say it's accurate that the inflation numbers are accurate, you have to deduct your real estate tax, your transaction costs when you purchase, you do a home inspection, you do appraisal, there might be origination fees, there's an attorney fee on getting into a property, and then on the sales side, you have a real estate commission, typically, again, you have attorney's fees and other recording costs. and then the maintenance of the home. So when you factor all those things in, the real rate of return on a home is negative. Now, that's a separate argument from whether it's cheaper to own a home versus rent a home. So I'm going to make this nuanced discussion point that what I'm referring to is if people truly understood that it might not be a good financial investment, maybe they're not going to try to extend themselves and purchase a $600,000 home because they think it's a good home. Right. Maybe they're going to just purchase what their family needs and buy a $400,000 home and live more financially comfortable and be able to withstand some financial upset in their life.
That's a good point.
So we have a whole chapter in the book that talks about whether or not home ownership is a good financial investment. So now, this is a long-winded answer to your question, is it a good time to buy now? So I think if people look at home ownership as consumption rather than investment, and they can comfortably afford it, it's really a life decision to make. The average person lives in their home for 9 years. That's the most recent statistic I've seen. So I think it depends where they are in their life. Now, I believe where we are in the real estate cycle is we peaked out at the third quarter of 2006. We hit the bottom in near the end of 2012. Since 2012 to today, we've averaged on a national average basis 5 or 6% appreciation per year. I think we're past the trend line, heading towards the next peak. So whenever you're above, the prices are above the trend line,
right,
your risk increases. So, but if you're in it for the long haul, you can comfortably afford the mortgage. It doesn't really matter where you are in the cycle. If your plan is to be in the house for 20 or 30 years, I think it's difficult to time the market.
Right.
So one more point I want to add to that is it can be a good investment if you buy at the bottom and sell at the top, right? I mean, that's not rocket science there. And that's why we try to have the chapter in the book about the real estate cycle, so you can kind of figure out, all right, where is my market in this cycle? Right. Should I wait a few more years to buy, or I know that the prices might go down, but I can comfortably afford this mortgage and the intangibles are worth it to me to own a home now.
So, I mean, and part of the, what your point addresses is how long do you plan to stay in the home? That has a lot to do with, is this a good time or not? And then if it is a short-term living situation, what are you going to do with the home at that point? Are you going to sell it, or are you going to hang on to it? Because that makes a difference too.
Sure.
So I like the points you're making, because it's really not waving people off of buying. It's just saying, hey, let's do this responsibly. Because you touched on a good point about the consumption. My grandfather he was a real estate investor, and that's how I got into real estate, working property management for him. But before it was legally possible to work anywhere else, I was working in property management, and he always taught me that the home you live in is not an investment. It's a debt, it's an expense, it's a liability. The home that you rent is an investment, and it's a source of income, or I should say rent out, not you as a tenant. And one of the things that we always did was we always fixed up our rentals before we fixed up our primary residences, because we wanted to attract the best tenants to create the best income, so that eventually we could fix up our own homes. But I love the points you're making, because it's not doom and gloom. It's being practical and thinking through your purchase decision.
Mm-hmm. Well, and I'm glad you make that distinction, because I'm certainly not saying that you can't make money investing in real estate. I do it for a living.
Right.
That's where I derive most of my income. So, but that's a separate set of criteria and analysis that you look at there. Is the cash flow going to be positive if you buy this multifamily? What are my expenses? As long as it's cash flow positive, it's a good investment. And then if you're purchasing a fix and flip, you buy it low enough, and you can add value above and beyond what you put into the property. Of course, real estate can be a great investment. But what I was referring to specifically was single family home ownership, where you're living in it as your primary residence.
The primary residence, yeah. It's when I bought the home that I live in right now in 2007. So we hit a blip where we had what we thought hit the bottom. So I bought, and then of course we found a new bottom soon after, later that year. And I can remember my one of my clients bought at the exact same time I did. We both closed escrow in the same week, and they called me in a panic. We've just lost value, and I said, hey, so did I, but I'm not going anywhere. So I'm going to ride this thing through. So we watched our home lose $50K in value from what we paid for it, and now we're up $40K. So it's the analogy I always give people is the painting on the wall might be worth $1 million, but it's not worth a dime until you sell it.
That's right.
It's getting back to the point you made about the length of stay and the purpose of the house. But I wanted to ask you, because of your extensive background in both investing and with the banking industry, and then of course the research that went into this book, do you think we are in danger of repeating history in a sense? I mean, I know we don't literally repeat it, but I mean, in some sense, is there a danger that we're heading back into the same patterns that created the bubble burst in, depending on what part of the country you lived in, anywhere from 06 to 08?
I think so. I think that, so we talked about how real estate runs in cycles. So will it be as harsh as the last bubble bursting? I don't think so, but what we see is a lot of the same things happening. And so what happens leading up to the peak of a bubble is if more mortgage money is available, it gets capitalized into higher home prices, right? And then it ends up feeding on itself, and people think that this real estate's a great investment. They see homes appreciating 6-10% depending on what markets are the higher markets, and they say, I want to get in on that.
Right.
So it kind of feeds on itself. But to the point about getting back to what we talked about earlier about the mortgage money not being tight, the FHA is allowing debt to incomes up to 57%, 96.5% LTV, 97 at Fannie and Freddie. Credit scores as low as 580 at FHA.
Yeah.
Right. So I know I'm talking alphabet soup here, but all these things mean that they're just continuing to loosen the underwriting criteria. So what happens in the typical real estate cycle, they are loosening it just at the time that they should be tightening it, right? So it's pro-cyclical.
Right.
So everything it's like a crescendo, and the prices go up and up. The money gets easier and easier, because I just read an article this morning talking about no money down loans are available today.
Yeah.
So again, they're loosening, and what they use as the argument for that it's okay is that the default rate is low. Well, the default rate should be low in an appreciating home and price environment, right?
Yeah.
Who's going to default if there's positive equity, right? They only default if there's negative equity. So that argument holds zero weight, but every article I read, or every interest group or activist group that wants to push housing to lower income people uses that as justification.
Well, and I mean, also arguably they're doing it to the loan that is like the lowest point of entry. I mean, it's people arguably that have more fiscal responsibility or ability are not doing FHA loans. They're doing conventional loans, or they're all cash. At least, and I'm speaking from my experience here in Southern California, the people I'm physically working with, and the people that are struggling to figure out how to get a home are taking advantage of FHA. So it's the people that are most likely to default getting the least point of entry into the market, which, and then here we go again. Now, the only good news about that, in a sense, is that at least in San Diego, it's extremely difficult to find a property that's FHA approved, because the price point for most FHA buyers that I've worked with are below the median home price of San Diego, which means they're going to end up in a condo. And of course, condos have to be FHA approved. And those are harder and harder to find, because we're coming across a lot of expired FHA approved. Like these condos don't bother to renew them, and that may be a result of what they went through last time.
Well, and so I just went to a brokers conference where a representative from FHA was there talking about how to get those condos that are not approved to get them approved. So that's gonna turn 180 degrees, and you're gonna see a lot more condos getting FHA approval, and at surprisingly low owner-occupied rates.
Well, and I'm not trying to put down anyone that's trying to get a home and the FHA is their only answer, but it's, when you've been through this before and you're seeing people start to repeat the pattern of what created a disaster last time. I mean, you even pointed this out in your book that the only thing worse than what we went through in the last bubble burst was the Great Depression. Mm-hmm. And that's not a great benchmark to have to compare something to. Mm-hmm. So to me, it's just concerning. But the battle you're fighting though is you've got an agent that may not be doing a regular business yet, and they get an opportunity, and they're not gonna try to talk somebody out of buying. They're gonna try to help them do whatever they can to buy. So and I know that. I don't know about you, but I mean, I literally had a client accuse me of not warning her that the bubble was going to burst. Like I had the crystal ball and I should have told everyone. So I know people were blaming anyone that bought a home was probably blaming their realtor and their appraiser and their lender. But I mean, there's that tightrope. I mean, you have to do right by your clients. We have a fiduciary duty, but we also need to do right by our families and make a living. So how do you see that? Where's the moral compass?
Well, so I think that the right thing to do is to explain it to them, is to help them become educated, because that's where the problem really begins, in a lack of education of the buyers, right? So that's one of the purposes of the book, is to educate the buyers. So I think it's important to explain it to them. At the end of the day, it's the client that makes the decision. So we give them the information, and if they want to go and only put 3.5 or 3% down, and they want to go to the hilt and have debt to income at 57%, that's beyond our control. But what's within our control is to be honest with them about the market and whether or not home ownership is a good investment. They're going to make their decision regardless. Most of them, even though I say this to clients, I don't know if they don't believe me or that the emotion is too much. And ultimately, my job is to represent what they want to do. Right. So I give them the information, and they're going to do what they're going to do.
Well, there's a lot of drivers, John. A lot of people in California, it's their retirement fund. They sell in Southern California and they move to Nevada, and it finances their retirement to a certain degree. And there's other drivers, isn't there? I've got a question. Fannie Mac and Fannie Faye, I'm probably not pronouncing them. Am I correct? They were established in the 1930s, in the Great Recession. And what has been their role, because in the collapse, and their role at the present moment?
So FHA came out of the 30s. Freddie Mac, I believe, was in the 60s to create competition with Fannie Mae.
And these are kind of quasi independent, but they are covered by the taxpayer. Is that correct?
That's right. I mean, so the profits go to the investors, the losses go to the taxpayers. So
can I buy that? Can I get into that?
So it's a corrupt system, and that's why they're in conservatorship now, because it's proven failed. They're proven failed business models. So they've been in under FHFA conservatorship since I think it was 2008. And that's why there's finally talk about doing something and getting them off the books of the government. I think that's important. So what was your question about Fannie and Freddie?
Yeah, what is their role in the collapse and their role in the present situation?
So Chris and I believe that they played a critical role. So HUD is the mission regulator of Fannie and Freddie. HUD had affordable housing goals starting in the early 90s. I think it was at 30% of the loans they purchased had to be from low to moderate income borrowers. That continued to increase each year up until 2006, where it capped out at 56% of all loans that Fannie and Freddie purchased had to come from low to moderate income borrowers. So think about that. Our own government was pushing these higher risk mortgages, right? HUD was pushing it. So HUD still has these affordable housing goals, and we talk about this in the book, about our recommendations on how to correct some of these structural flaws. And one of them is to get rid of the affordable housing goals. Now, if Fannie and Freddie were not quasi-government agencies, politicians wouldn't be able to manipulate who gets credit. So that's why I think that it's been in limbo for 8 years, coming up on 9 years, because I think that the politicians like to buy votes by saying we're going to help with affordable mortgages to low to moderate income borrowers. Now, I believe that we need to help those that need help. But I think many of the policies hurt the very group that it was targeted to assist. They ended up losing their homes. So they're not any better off. You know, it's a complicated thing. And some of the answers to your question, I've really answered in simplistic terms, but it goes much deeper than we've scratched the surface on here.
Well, I know we're coming up on our time, so I want to thank you very much, John, for being our guest today. And it's a huge topic. We probably could do 2 shows on it. But I really appreciate you coming on and sharing your viewpoint. I want to remind people that the book is Easy Money and the American Real Estate Ponzi Scheme, which you can get on Amazon. And then, John, do you want to share with people the best way to reach out to you and get in contact with you?
Sure. My website is www.agostinelli.com. That's AGOS as in Sam, TINELLI.com. We also have a book website, easymoneyinamerica.com. We have the contact buttons on there if you want to be kept in the loop on recent op-ed pieces by both Chris and myself. We have them on there. Our blog pieces go on there too, so you can easily sign up for the newsletter or just click on the Contact Us Now button.
Awesome. And Jonathan, you want to share where people can get in touch with you?
Yeah, but before that, I know this subject seems a bit complicated, but I think it's really, as a professional real estate professional agent, the more you can educate yourself about the industry, about where it's going, the more effective you're going to be. So I thought it was a fantastic interview, and we've touched many interesting things. How to get hold of me? It's quite easy, folks. You can get me on Twitter, on my own Twitter feed, which is at Jonathan Denwood, or you can email me at jonathan@mel-right.com. And if you've got any questions, suggestions for the show, that would be great. Back to you, Thomas.
All right. And I want to, again, congratulate us, but you especially, Jonathan, on 100 episodes. And I want to thank everyone for making that possible. We appreciate you listening and downloading, and we love your comments. I'm Thomas J. Nelson. I am your co-host here, and I'm also a residential realtor in San Diego, California, where I'm never too busy for your referrals. And you can find me on thomasjnelsonrealtor.com or on social media. And again, I want to thank John Agostinelli of the Agostinelli Realty Group out of Massachusetts and author of Easy Money. Check out the book, check out his blog, a lot of interesting stuff, folks. And I agree with Jonathan. Unfortunately, one of the most unique selling propositions a realtor can offer his client to separate himself from the masses is that they're educated and they actually stay up on current events. So many people gloss over these topics because they're not fun to talk about, are they? Because they seem like a threat to our business, but they're really not. I think if you approach it with an educated mind, you actually find the opportunity in any kind of market. John, thanks again for joining us on the show. We really appreciate you being here, and good luck with the book.
Thanks so much, Thomas and Jonathan, for having me on. Really appreciate it.
All right, folks, we'll be back next week on the Mail-Right Real Estate Agent Podcast Show for episode 101. Until then, have a great rest of your week. Thank you. Bye-bye.